Welcome. Let us continue preparing you to pass the Securities Industry Essentials (SIE) exam. This video will examine the details regarding variable annuities, including the different types, their unique tax implications, as well as suitability considerations. A follow-up video to this segment will describe municipal fund securities such as local government investment pools, LGIPs, Section 529 educational plans, and 529 ABLE plans. SIE candidates should place special emphasis on the mechanics of these products as well as on the appropriate client disclosures. Annuities. An annuity is an agreement between a contract owner and an insurance company. The owner gives the insurance company a specific amount of money, either all at once or over time, and in return, the company promises to provide a person, that is, the annuitant, with income either immediately or at some point in the future. The contract owner may designate any person as the annuitant. However, the annuitant and the contract owner are usually the same person. Most annuitants choose to start receiving their income payments when they retire. Annuities are typically considered long-term investments that many clients use to supplement their work-sponsored retirement plans and/or their IRAs. A significant benefit offered by annuities is that the growth in the accounts is tax-deferred. However, two drawbacks are that purchasers of these investments often face long holding periods and may be subject to significant surrender charges and/or tax liabilities if assets are withdrawn too quickly. From an investor's perspective, it's important to understand the different features of the contracts. The majority of annuities are non-qualified, meaning that the contract owner invests money on an after-tax basis with the interest credited to the account accumulating on a tax-deferred basis. In other words, an annuitant is not required to pay taxes on the income or growth until she begins taking distributions or withdraws funds from the account. As is the case with retirement plans, these contracts don't generate capital events. If any portion of a withdrawal is subject to taxation, it's taxable at the same rate as the owner's ordinary income. Non-qualified annuities will form the basis of this examination of annuities. Fixed versus variable annuities. There are two types of annuity contracts, fixed and variable. With a fixed contract, the investor receives a fixed rate of interest, and the investment risk is assumed by the insurance company. For this reason, fixed contracts are not considered securities and are governed under state insurance law only. On the other hand, variable contracts offer returns that fluctuate, and the investor assumes all of the investment risk. Variable contracts are considered securities and are subject to SEC, FINRA, and state insurance regulation. As is the case with all variable products, a prospectus must be delivered prior to completing the sale of any variable annuity. Variable annuities. Variable annuities were created to provide investors with greater protection against inflation than traditional fixed annuities can offer. The contract owner is also given a level of control over how her contributions are invested, at least during the annuity's accumulation phase, the period during which she's depositing funds into the annuity. Although only insurance companies issue variable annuities, these contracts are not considered forms of life insurance. A firm that offers variable annuities must be a broker-dealer registered with the SEC. Additionally, the registered representatives who sell variable annuities must obtain a state insurance license and either a Series 6 or Series 7 FINRA registration. In a variable annuity, when a person decides to annuitize, she will begin receiving payouts from the annuity and in turn relinquish control of the contract's principal value to the insurance company. Once benefit payments start, the amount will vary from month to month depending on the performance of the investments in the separate account. If these investments perform well, the payments to the annuitant may increase. Conversely, if they perform poorly, the payments may decrease. For variable annuities, the insurance company does not guarantee a minimum rate of return. These products are not suitable for all investors. Before considering variable annuities, investors should exhaust all their options for saving for retirement on a pre-tax basis, such as through IRAs or 401k plans. The separate account feature is unique to variable products. As the name implies, the assets in an insurance company's separate account are segregated from the company's general account, which is used for fixed annuities. All income and capital gains generated by the investments in the separate account are credited to it. Moreover, any capital losses incurred by the separate account are charged to the account. However, it is not affected by any other gains or losses incurred by the insurance company. If the company becomes insolvent, its creditors may not make claims against the assets in the separate account, but they may claim against the assets in the general account. The separate accounts of variable products are generally required to be registered as investment companies under the Investment Company Act of 1940. For variable annuities, the separate accounts typically contain various underlying portfolios or sub-accounts, similar to the fund choices that investment companies offer their investors. For instance, one may have a sub-account for growth, another for income, a third for long-term bonds, and yet another for aggressive growth, along with many other sub-accounts as needed. Contract owners can allocate their payments among these different sub-accounts based on their investment objectives. Additionally, they are generally allowed to transfer their money from one sub-account to another as their investment goals change. Each of the sub-accounts typically corresponds to a different underlying mutual fund, such as a large-cap stock fund, a long-term bond fund, or a money market fund. Another sub-account may have a fixed rate of return guaranteed by the insurance company. The value of the other underlying sub-accounts will fluctuate based on changing market conditions. In a variable annuity, a contract owner who invests in any sub-account other than the fixed-rate sub-account assumes all investment risk. An insurance company does not guarantee a minimum rate of return for most of its variable annuity sub-accounts, meaning market risk is the primary risk that a variable annuity contract holder faces. Variable annuities are classified as securities. Therefore, they must be registered with the SEC and sold by prospectus. The separate accounts and underlying sub-accounts must also be registered with the SEC as investment companies. The life of a variable annuity. Most variable annuities involve two periods, the accumulation and the annuity period. In other words, there are a pay-in period and a payout period. The details of these two are summarized below. Accumulation period. The accumulation, or pay-in period of a variable annuity, begins when a person first directs her contributions to the insurance company. During this period, the value of the annuitant's investment in the separate account is calculated using a measurement known as an accumulation unit. Essentially, accumulation units are purchased at net asset value, or NAV. The NAV of the sub-account units is calculated using the same method employed by mutual funds. Specifically, NAV per unit equals total net assets divided by total units issued. This calculation occurs at the end of each business day, usually at the close of trading on the exchanges. The actual price that annuitants pay for their units is the next calculated NAV. This approach is referred to as forward pricing. However, the value of the units fluctuates along with the changing value of the underlying portfolios of the separate account. If the investments in the separate account perform well, the units will increase in value. If they perform poorly, the units will decrease in value. With each investment, the insurance company first deducts any applicable commissions or other charges, and then uses the remainder of the annuitant's investment, the net payment, to purchase accumulation units in the selected sub-accounts. Cash surrender. Annuitants may cancel or surrender their variable annuities at any time during the accumulation period and receive the annuity's current value. Additionally, annuitants may choose to withdraw a part of their annuity's value at any time, which is known as a partial surrender. However, as mentioned earlier, an annuitant may be required to pay surrender charges based on how long she has held the annuity. The surrender will also lead to the requirement to pay taxes on any increase in the value of her annuity. For variable annuities, insurance companies do not guarantee a minimum cash surrender value. Therefore, if a person surrenders her annuity, she may receive less than the total amount she has invested. Loans. Insurance companies generally allow their contract owners to borrow against the value of their annuity contracts during the accumulation period. Unlike a withdrawal, the advantages of taking out a loan include the ability to avoid surrender charges, potential taxes, and early distribution penalties. Loans taken from annuities typically must be repaid within a specific time frame. However, if the loan is not repaid, it will be considered a distribution and may be subject to taxation and early distribution penalties. Death benefits. Although variable annuities are not life insurance policies, these contracts often include an associated death benefit. Therefore, at the time of purchase, the contract owner designates a person as her beneficiary to receive this benefit in the event of her death. If the annuitant dies during the accumulation period, the beneficiary receives the greater of 1. The sum of all the contract owner's payments into the annuity, or 2. The value of the annuity on the day of the annuitant's death. For example, if a person has paid a total of $50,000 into a variable annuity and designated his son as his beneficiary, and the annuitant dies 1 year later when the value of his annuity is $45,000, then the beneficiary would receive $50,000. Because mutual funds lack the death benefit feature, this is one reason clients may prefer to purchase annuity contracts, despite the fact that they are relatively more expensive. The annuity period. The annuity or payout period begins when an annuitant decides to receive income payments from the annuity. Prior to this point, during the accumulation period, the contract holder is permitted to surrender the annuity in exchange for its current value. However, once a person decides to annuitize, she may no longer surrender the annuity or withdraw money freely from it. Instead, she receives payments based on the performance of the assets in the separate account. Annuity units. At annuitization, the insurance company converts all accumulation units into annuity units. Annuity units represent the accounting measurement used to determine the dollar amount of each payment made to the annuitant. The number of annuity units represented in each payment is fixed at this time. The value of each payment made to the annuitant is based on a fixed number of annuity units multiplied by a fluctuating value. To calculate the annuitant's payment, the insurance company considers the following: the annuitant's age and gender, the settlement option selected, the annuitant's life expectancy, and the assumed interest rate. Settlement payout options. There are several methods for receiving payments from an annuity. An annuitant may choose from the options described below to receive benefit payments from the contract. Straight life annuity. A straight life annuity is a contract in which an annuitant receives monthly payments for as long as she lives, but this method makes no provision for a designated beneficiary. Therefore, no payments are made after the annuitant's death, even if only one payment had been made before the person's death. Remember, the contract's death benefit ceases once the holder decides to annuitize. This payment option carries the most risk, but also provides the annuitant with the highest payout compared to all of the options. To avoid overwhelming you with lengthy videos, we'll keep it short and easy to digest. Join us for a follow-up video continuation, where we will continue the discussion of municipal fund securities and end with 529 plans. As always, please like this video so others can benefit too. If you are a new viewer, we invite you to join our family with a free subscription. Thanks.